Now let's touch on non-reoccurring items. So what are some non-reoccurring items that you guys report? And then I can talk about how it benefits or disadvantages on our side.
Sure. So it seems to me like you guys are able to add back a non-recurring expense to the benefit of the taxpayer. However, non-recurring income is actually a disadvantage to them because obviously it's non-recurring, so it can't be counted on to be had in the future.
For example, I had a client that was a restaurant owner and they did a lot of improvements to the property. It did a big remodel. So she had, let's say 200,000, I don't remember the number, 200,000 in expenses, but that was a one-time thing because it's like a one-time remodel. So we look at her tax returns, we're like, ooh, you had this huge expense, like this could cause a problem. But it's non-reoccurring. Let's show what that was for. We showed invoices that it was a remodel, and we were able to kind of wipe that where we don't have to hit that negatively against you. Now, for the non-reoccurring income, it could be something like, let's use the body shop, for example, and then you had a side business doing maybe some mechanic work or selling tires or something, but it was just a seasonal thing and you're not going to do it again. Well, if that income is not going to continue, I can't count that as income for you because it's like a one-time thing, right? But what's a solution on your side that still helps me?
Yeah, so a strategy for that would be I commonly see clients report things as other income that are actually part of their business service, but it might not be their primary business service, but one that's still going to continue. So from a tax strategy standpoint, you don't want to report something as other income unless it's truly non-recurring, because otherwise from a lending perspective, you're going to see that other income, you're going to ask about it, rather than if it's just grouped into regular gross receipts and sales, then it's not going to be an item that even needs to be addressed if it's going to continue. And then another thing too, just from a tax reporting standpoint, as a CPA and for anybody watching, we can be better about delineating non-recurring expenses on the return. So that way, when you guys look at it, it's just further substantiated that it is non-recurring because we've reported it that way on the tax return. And so then also it can bear the question with the client of like, hey, I see that you have non-recurring expense here, which might not otherwise come up because, I mean, every business is different.
Okay, so I like that because in my example of that large amount, they didn't put it as a non-reoccurring expense. It was just a large expense that I noticed that they hadn't had before. And I said, okay, what is this? And then we were able to dive in deeper. Now, if that was automatically on the return, I don't think we would have had to question it. So that's important that your CPA is strategizing and putting items where they need to go that helps benefit us as well. And then back to the non-reoccurring income piece, let's use the body shop. If they are selling tires as like a side income, but they're going to continue that, we can use that income. So let's not put it under non-reoccurring, even if it's not your primary source of income. It's a secondary income, but it is still reoccurring. So again, make sure that your CPA or get with Nicole to make sure that you're just putting all that properly where it gets you home ownership, but gets you the tax benefit.